Hello, 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 hello. Welcome to our next chapter, that is taxation of dividend, deemed dividend, liquidation, and buyback. So these are small four topics. So first we'll start with section 80M. 80M talks about intercorporate dividend deduction. Intercorporate dividend deduction, this is actually a chapter 6A deduction. Now this deduction is only available to domestic companies. This deduction is only available to domestic companies that receive dividend from a domestic company or from a foreign company or from a business trust. So only and only when a domestic company receives any dividend from another domestic company, from a foreign company or any business trust, they will get a deduction of the dividend received or the dividend distributed by the domestic company up to 1 month before the 139 month due date, that is your return due date. Return due date, say 1 month before. So any amount that has been distributed before 1 month from the due date, whichever is lower, this deduction they will be getting. Okay. Now next topic is your deemed dividend. Deemed dividend has basically five sections: 222 A, B, C, D, and E. So 222 A talks about distribution of assets. So deemed dividend is when dividend has actually not been given. Dividend is usually given in cash. When any other asset has been given to the shareholders, in such a case, this asset's fair market value will be considered as a deemed dividend. It will be deemed to be dividend and it will be taxed also as dividend. So if there is any distribution of asset, so the deemed dividend will be the fair market value of the asset. If there is distribution of debentures, it will be fair market value of debentures. If there is distribution of assets on liquidation, that is the company is being liquidated, so instead of paying cash to the shareholders, we are directly giving them the asset. So in such a case, it will be the fair market value of asset. And if there is any reduction of share capital, that is the company's, that means the company is giving some assets to the shareholders and the shareholders have agreed to reduce their share capital. So in such a case, the deemed dividend will be the fair market value of asset. Okay, now deemed dividend, it will be to the extent of accumulated profits, whether or not they have been capitalized. Okay, and 222E talks about loans and advances by closely held or any unlisted company. So if any closely held company or any unlisted company is giving any loans and advances, this loan will also be considered as a dividend, because what would people do? They would they would give dividend in the form of loans, and then they would say, boss, we did not receive this loan back, and they will write it off. So therefore this taxability will not be happening in the shareholders hands. Therefore loans and advances have also been known as deemed dividend only for closely held and unlisted companies. So if loan and advances have been made to shareholder having greater than or equal to 10% voting power in closely held company. So if the company has given its shareholder any loan and this shareholder has equal to or greater than 10% voting power, it will be taxable to the shareholder. Then next is, if any concern, that is if any other party, if the loan has been given to any other party where this shareholder who has 10% voting power in the closely held company has 20% voting power, equal to or more than 20% voting power in this concern, then in such a case it will be taxable to the company. And third is any person on this person's instruction, then it will be taxable to the first person. Got it? So you might be getting confused in case 2. That means, for example, this is my shareholder, this is company 1, this is company 2. Now this shareholder has 10% voting power over here and 20% voting power over here. So our first case was, if the loan has been given by company 1 to the shareholder, that is my case number 1. My case number 2 is if my C1 has given loan to C2, that is your case number 2. That means it will be taxable to C2. Got it? And third option is when C1 has given a loan to some other party on instructions of this person. Okay, so I hope this is clear. So deemed dividend to the extent of accumulated profits. Okay, then next is liquidation. So on liquidation, what happens? The firm is getting shut. So in such a case, the company is getting shut. So you are giving assets to the shareholder. So any asset transferred by the company So since ideally what happens if a company is getting rid of assets, usually what would happen, it would be taxable to the company, but the company is shutting down. So therefore for the company there is no tax, but for the shareholder it will be considered as a capital gain. Now, capital gain, what will be the fair value of consideration? Of course, we need three things: fair value of consideration, cost of acquisition, and period of holding. So, your fair value of consideration is if the person has received any cash, that is, if the shareholder has received any money, plus if he has received the asset, the fair market value of that asset minus deemed dividend under section 222C. So whatever amount we have already deemed to be dividend under section 222C, because that also talks about liquidation, that amount will have to be subtracted to get your fair value of consideration. Then next is your period of holding. Your period of holding will be considered from date of acquisition till date of liquidation. The entire period will be considered as a period of holding. And the cost of acquisition of asset will be fair market value of asset. Okay, so this is your liquidation. And next point is 115 QA. The section is 115 QA, which talks about buyback of shares or securities. Remember, it is buyback, that is BB. So I will help you learn the rates also. So if a domestic company buys back the shares or securities, it will be, first of all, it will be exempt to the shareholder and it will be taxable to the company because the company is buying back. So the rate, first we'll talk about the rate. So BB section, our section is about buyback, that is BB. So BB means 20 and 12. So how does it mean 20 and 12? Look, in Hindi, 20 is called as 20 and 12 is called as 12. So therefore, BB stands for 20 and 12. So 20, 12 and 4, that is 20, 12 and 4. Then on what amount will this be taxed? It will be taxed at your buyback price minus your issue price. That is the share that it were originally issued for. That will be subtracted from my buyback price. And it will be taxed at 23.296%. Sir, how do you get 23.296%? This 20% plus 12% plus 4%. Got it? Now next is your foreign company. So if the buyback has been done by a foreign company, in this case, it will not be taxable to the company, but it will be taxable to the shareholder, the capital gain. And with this, we are done with this chapter, and I will see you in the next one, that is taxation of political parties and electoral trust.